Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 12, which covers investments. And in Chapter 12, we learn about the various approaches that companies use to account for investments that they make in the debt and equity securities of other companies. So with our debt securities, this is essentially when we purchase bonds of another company, and equity securities represents ownership, purchase of stock in another company. So as it relates to our debt investments, investors, they use accounting approaches that either ignore the changes in fair value or those that include the fair value changes. And it ultimately depends on, is this debt classified as held to maturity? Is it classified as available for sale, or is it classified as a trading security? When it deals with equity investments, when an investor owns enough stock to significantly influence the investee but doesn't control it, they use what's called the equity method, and they ignore fair value changes. And then in the other scenario where they do have significant influence, there's another approach that is taken. So with this first question, this is going to give us a good understanding of how we differentiate between the two. So here with this question, this fact pattern, it essentially asks us to determine the reporting category that each of the investments listed below most likely should be accounted for based on the information provided. So in this case, the first one we see, it states 35% of non-voting preferred stock of American Aircraft Company. Sorry. All right. So again, one of the key things to keep in mind. So we know first and foremost that we are dealing with equity. How do we know? Because we are dealing with stock. So when we are dealing with equity, again, one of the key things is we need to ask ourselves, is there significant influence? There's characteristics of the equity investment that we need to keep in mind. And just to give you guys some, quick background, here is how we determine. So these are the reporting categories for equity investments. The first is when the investor does not have significant influence over the operating and financial policies of the investee. And this is typically when they own less than 20% of the voting stock. If this is the case, then the reporting method used by the investor is fair value through net income. This is similar to the trading securities approach used for debt. The investment is reported at its fair value, and unrealized holding gains and losses are included in net income unless the fair value is not readily determinable. The next characteristic of an equity investment is if the investor has significant influence over the operating and financial policies of the investee. This is typically between 20 and 50% of the voting stock. In such case, the reporting method used by the investor is the equity method. And this is when the investment is reported at cost adjusted for the investor's share of subsequent earnings and dividends for the investee. And then the last characteristic of an equity investment is when the investor controls the investee. And this is typically when they own more than 50% of the voting stock. And in a case like that, the reporting method used by the investor is consolidation. The financial statements of the investor and the investee are combined as if they are a single company. So again, the first thing is, do they have significant influence? Less than 20%. If so, we use the fair value through net income. The second characteristic is, does the investor rather have significant influence? That's ownership between 20 and 50% of the voting stock. If so, they use the equity method. And lastly, do they control the investee? If so, consolidation is necessary. So if we get back to the questions and the fact pattern, here we see they own 35% of the non-voting preferred stock of American Aircraft Company. So in such case, we use the fair value through net income. All right. And in this case, the reason why we do it is because they do not own, and it can be a little confusing here, but one of the key things is that it says 35% of the non-voting preferred stock. So someone might get confused and, look at the percentage. Here we see 35%, and we might be thinking, well, hey, the investor has significant influence. One of the key things is that the 20%, the 20 to 50%, and the 50+%, it needs to represent voting stock. This problem states non-voting stock. So therefore, we utilize the fair value through net income option. Next, we have treasury bills to be held to maturity. So with this problem, we essentially look at our debt investments, right? And when we're dealing with our debt investments, similar to our equity, there's various ways in which they are accounted for. So as we account for our debt investments, one of the key things is we need to determine how is it going to be classified. So the reporting approach for held to maturity, this is used for debt for which the investor has the positive intent and ability to hold it until it matures. Next, we have trading securities. These are, those debts that's used and held in an active trading account for immediate resale. And then we have available for sale. This is basically used for debt that does not qualify as held to maturity or trading. So we don't necessarily know if we're going to hold it till maturity, and we don't know if we're going to trade it. We're not trying to trade it, but we might. So everything that's within that gray area falls within available for sale. So when it is held to maturity, we do not account for any treatment of unrealized holdings and gains or losses. We don't care about the fluctuation. Why? Because we don't plan to sell it until it matures. Trading securities, any unrealized holding gains and losses, it's recognized in net income. Therefore, it's retained in earnings as a part of the shareholders' equity, and it's carried on the books at fair value in comparison to held to maturity, where it's carried in the balance sheet at amortized costs. Next are available for sale. It is recognized in other comprehensive income and therefore reported and accumulated other comprehensive income in shareholders' equity. And again, it's carried in the balance sheet at fair value. All right. So just some insight to know, how to approach it based on the classification and the characteristics. So we have treasury bills held to maturity. It tells us right in the wording, securities held to maturity. Then we have a 2-year note receivable from an affiliate. We're going to hold this until maturity because we want to receive the note from an affiliate. So this is considered securities held to maturity. Next, we have accounts receivable. Accounts receivable does not represent a debt or an equity investment. That is simply when we have provided a service or sold products to customers on account, and they're promising to pay us in the future. So this would be none of these. Next, we have treasury bond that's maturing in 1 week. So you might look at the fact pattern and say, hey, well, we're not holding it. The problem says that it's going to be maturing in 1 week. So we've held it until it has matured. So this represents securities held to maturity. Next, we have common stock held in an investment account for immediate resale. So this would be classified as fair value through net income. So we're holding on to the common stock and we are planning to resell it. All right, so this would be considered that we do not necessarily have significant influence. And when we characterize equity investments for which we do not have significant influence, which is less than 20% of the voting stock, we approach it as fair value through net income. 7, we have bonds acquired to profit from short-term differences in prices. This would be trading securities. We know that we want to be able to, buy low, sell high. Next, we have 35% of the voting common stock of computer storage devices company. So in this case, we own between 20 to 50%. So we have significant influence. So therefore, we use the equity method. All right. And the key difference between the first and the second is that, or the first and the eighth rather, is the eighth says 35% of the voting common stock. This one states 35% of non-voting stock. So that's the key difference. For 9, we have 90% of the voting common stock. So because the voting stock owners percentage is more than 50%, in such case, the method used would be consolidation. 10, it states corporate bonds of primary smelting company to be sold if interest rates fall between 1.5%. Again, there's no guarantee that we're going to hold it. There's no guarantee that we are going to sell it because, again, what if the interest rates don't fall between 1.5%? We're basically going to keep it. So because this is not necessarily a held to maturity and it's not necessarily a trading security where we know for sure we're going to sell it, this falls into the securities available for sale. Next, we have 25% of the voting common stock of Smith Boundaries Corporation. It's 51% family owned by the Smith family, and the fair value is readily determinable. All right. So we look at this fact pattern, and if we consider again the classifications for our equity investments, we need to consider the fact that, hey, wait, it's saying that the fair value is readily determinable, right? So in such case, if we look back to our fact pattern, because we know, and again, we go back to this information here. So it says the investor does not have significant influence over the operating, so typically owns less than 20%. So keep in mind, it says typically, it doesn't say must own, but typically. So we use a fair value through net income for this option because it states, similar to the trading securities approach, investments reported at fair value unless the fair value is not readily determinable. In this case, we know what the fair value is. It is readily determinable. So therefore, in this example, we would use the fair value through net income option. Next, we see 17% of the voting common stock of Shipping Barrels Corporation, and it states that the investor's CEO on the board of directors of Shipping Barrels Company, right? So one key we need to keep in mind, it says that the investor's CEO on the board of director of the Shipping Barrel Corporation. So if we pull this back up again, the investor has significant influence over the operating and financial policies of the investee. So again, it says typically. So here we see that it's 17% ownership, but it says that the investor's CEO is on the board. So therefore, they do have influence over the operating and financial policy. So based on this nuance, the correct answer is the equity method. All right. So again, as we go through this problem, there's some key things to keep in mind. You need to consider the percentages. And then especially when we are dealing with the equity, we also need to consider that it says typically as it relates to the percentage in the fact pattern, we need to determine whether or not there is significant influence over the operating and financial policies of the firm. So this brings us to our next question. And for this question, it states, FF&T Corporation is a confectionery wholesaler that frequently buys and sells securities to meet various investment objectives. The following selected transactions relate to FF&T's investment activities during the last 2 months of 2024. At November 1st, FF&T held 66 million of 25% 10% bonds of Convenience Incorporated purchased May 1st, 2024 at face value. Management has the positive intent and ability to hold these bonds until maturity. FF&T's fiscal year ends on December 31st. So one key thing to keep in mind, a calendar year is from January 1st to December 31st, and a fiscal year is typically any other 12-month period. So when it comes to fiscal years, think of it from birthday to birthday. Very few people have a birthday on January 1st. So fiscal year, any other 12-month period, an easy way to remember it is from birthday to birthday. So calendar year, January 1st to December 31st, fiscal year, any other 12-month period. An example is from birthday to birthday. So it's asking us to record these journal entries. On November 1st, it says we received semi-annual interest of 3.3 million from the Convenience Incorporated bonds. So the first journal entry that we need to report, again, we are considering the fact that we're receiving 3.3 million. So our journal entry will be as follows. All right, we know we're receiving 3.3 million. One key thing to keep in mind, it says enter your answers in millions rounded to the decimal place. So November 1st, we receive cash, right? That goes without saying. And we know that anytime we receive cash, we debit our cash account. So we receive 3.3 million. Again, it wants us to enter 5.5 million as 5.5. So if you try to enter the whole dollar amount, it's going to show up as incorrect. So please keep that in mind. And then why did we receive this cash? We received interest revenue for the same 3.3 million. All right, so that's on November 1st. Now, if we scroll back up, it says we purchased 12% bonds of Fast Meal Enterprises at their $50 million face value to be held until they mature in 2027. Semi-annual interest is payable May 31st and November 30th. So we need to record the fact that we purchased these bonds on December 31st. So our journal entry would be as follows. We would debit investment in bonds, and it costs us 50 million, so 50.0, and we paid cash for these bonds. So because there's a decrease in our cash, we credit the cash account. On December 31st, it says we purchased U.S. Treasury bills to be held until they mature in 2 months for 10.6 million. So similar journal entry to December 31st. In this example, we purchased 12% bonds of an entity. And on December 31st, we purchased U.S. Treasury bills. They're both considered bonds. So our journal entry would be similar. We debit investment in bonds for 10.6 million. And then we credit cash for the 10.6 million. So now on December 31st, it's asking us to record any necessary adjusting entries relating to the investments. All right. So we need to keep in mind there's some interest that's going to be paid or earned, right? So in this case, let's think about the convenience bond. We know the convenience bond. Here, let's just know we have 66 million of 25-year 10% bonds, right? We purchased them May 1st, 2024. So we need to determine, okay, what is the interest that we are expecting to receive on the convenience bond? So our calculation would be as follows. So we know it's 66 million. We know that the interest is 10%, so just gonna change this up. So we'll make this a dollar amount. 10%. All right. And then we need to account for the interest that is passed. Because again, it lets us know that semi-annual interest is payable May 31st and November 30th. So on November 1st, we received semi-annual interest, but we need to account for the 2 months that have elapsed. The last time we received interest for the convenience bonds was November 1st. So therefore, interest has accrued for 2 months, for November and the month of December. So therefore, it would be 2 divided by 12. Right? Or we can basically do 2 divided by 12, which will give us about 17%. So from there, we ultimately determine how much interest we've earned. So 66 million multiplied by the interest rate, which is annual. And from there, we multiply it by the 2 months for which we are accruing interest. As we see here, the last interest payment was November 1st. So the month of November has passed and the month of December has passed. So therefore, we need to account for $1.1 million that has accrued for November and December. So our journal entry would be as follows. Are we getting paid the interest right now? No, we are not. So we need to account for the interest we are expecting to receive. So it would be interest receivable for the 1.1 million. And then we would credit interest revenue for the 1.1 million. All right. So that's for our convenience bonds. Next, we need to factor in our fast mill bonds. It says here for our fast mill bonds that we purchased these 12% bonds at their $50 million face value to be held until they mature. Interest is payable May 31st and December 30th. So in this case, we know that the bonds are worth 50 million. All right, so I'll just make these the same. We have 50 million. The interest percentage is 12. All right, and now we need to determine, okay, what's the time period that has elapsed? So purchase it December 1st. Therefore, 1 month has elapsed. So therefore, 1 divided by 12. So therefore, in order to calculate the amount of interest that we've earned thus far, it's the 50 million multiplied by the 12%, multiplied by the 1 month, which is December, because again, we purchased it December 1st. So therefore, here it represents $500,000. So therefore, the interest receivable for these bonds would be 0.5. So our journal entries would be as follows. Interest receivable for 0.5 and interest revenue for 0.5. All right. And then on December 31st, because these securities, are held to maturity, there's no entry that we need to make. Again, for December 31st. Again, securities that are held to maturity, they're not adjusted for fair value. So therefore, no journal entry required. All right. So again, you just want to keep in mind, as we are dealing with these bonds and we're dealing with these investments, we always want to determine, when we need to determine the interest, we multiply the face value of the bond by the promised interest rate by the percentage of time. For the first example, for convenience bonds, interest accrued for November and December. And then for the fast mill bonds, we only accrued interest for the month of December, 1 month. So this brings us to our next question. All right. So for this question, we have Tanner UNF Corporation acquired as an investment 200 million of 7% bonds dated July 1st on July 1st, 2024. Company management is holding the bonds in its trading portfolio. So again, what does that mean? That means that they plan to, sell it in the near future for a profit. The market interest rate yield was 9% for bonds of similar risk and maturity. Tanner paid UNF $160 million for the bond. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, 2024 was $170 million. Requirements are asking us first and foremost to prepare the journal entry to record the investment in the bonds on July 1st and interest on December 31st at the effective market rate. 3, prepare any additional journal entries to report its investment on the December 31st balance sheet. And then 4 is saying, suppose Moody's bonding rating agency downgraded the risk rating of the bonds. And in such case, Tanner had to sell the investment on January 2nd, 2025 for $150 million. Prepare the journal entry required on the date of the sale. So our first journal entry is as follows. Again, July 1st, we purchased these bonds. So how are we going to report it? It'll be investment in bonds. For the 200 million. And again, similar to the previous problem, it wants us to essentially, round the answer to the decimal places. So 200 would be 200.0. And we see that we paid 160 million for the bonds, but the bonds are worth 200 million. So in such case, we'll use what we don't know, or what we do know rather, to figure out what we don't know. So we paid 160 million, but we know that the investment on the bonds is 200 million. So in such case, the bonds were issued at a discount. All right. So one thing that I want you guys to keep in mind as it, relates to discounts on bonds, one of the key things is it's just like in our everyday life, right? If there's a low demand for a product, it's generally discounted, right? As you are preparing for the winter season, summer clothing, there's less of a demand. So summer clothing goes on sale. Vice versa, as you are preparing for the summer, winter clothing goes on sale because there's less of a demand. So when we are dealing with bonds, whenever the market is paying more than a corporation is promising to pay, there's less of a demand, because why would someone invest in bonds for a corporation that's only paying them 5% when if they invested in the market, they would get 8%? So because there's a lower demand for those 5% interest paying bonds, the corporation basically needs to, appease investors, and they do that by issuing the bonds at a discount, as we see in this case. So again, we debit the investment on bonds, we credit the cash that we paid of 160 million, and we credit the discount on bonds. So now on December 31st, we need to record the journal entry for the interest revenue that we've earned. All right. And how do we determine our interest revenue? We calculate it as follows. So we know that the bonds are worth 200 million. All right. So we have the 200 million. I'll make these a little bigger. All right. So we have the bonds for 200 million. And we know that the interest, the amount of interest that we are promising to pay, is 7%, but it says that we're making payments semi-annually, which means twice a year. So therefore, we have our 7%, but then we need to divide that 7%, or, we can do it this way. So 200 million multiplied by 7% gives us 14 million, right? So 14 million represents the interest that we are going to pay for the entire year. But again, since we are paying them twice a year, this 14 million would be divided by 2. So therefore, every 6 months, we are paying $7 million. So we're missing, all right, zeros. So 200 million. Yep, so 200 million multiplied by 7%, not 70, by 0.07%. So therefore, $7 million represents the interest that we are promising to pay, or they're promising to pay us rather. So we debit our cash because we're receiving 7.0. This is how much Tanner UNF Corporation has promised to pay us. But we also need to account for the discount on the bonds. So in order for us to, account for the discount on the bonds, we need to factor in this 40 being allocated over how long we anticipate holding these bonds. All right. So the next thing we need to do is we account for reducing the value and the discount on bonds. And the next thing, or we can, even work backwards and factor it in. So the market is paying 9%. So same scenario, 200 million. Let me just make sure it's the correct amount. Perfect. So we have 200 million. The market is promised to pay us 9%. So 200 million multiplied by 9%. The market would promise to pay us 18 million. So we need to find a difference between the two. 18 million divided by 2 will be 9 million. That's how much we would receive. That's how much we would receive if we were to invest in the market. All right. So now the next thing that we need to account for is how much is our interest revenue. So how do we determine our interest revenue? Again, it's based on essentially not just the face value, but how much we've actually paid for it, right? So just wanted to show you guys the difference between how much we would earn if we invested it in the market. We would earn 9 million each year versus 7 million. But again, because we want to appease bondholders, investors, in such case, we issued a discount. So in order for us to determine our interest revenue, that would ultimately be dependent on how much we paid. So we paid 160 million. The market would give us 9%. That would be $14,400,000 each year. And if we divide it by 2, it would be 7.2 million. So therefore, the interest revenue that we've earned is 7.2 million. And the difference between the two represents the discount on bond investment that is going to be amortized each time we receive a payment. So discount on bond investment. So 0.2 would represent the discount on the bond investment. So again, when we are calculating the cash that we are receiving from the corporation, they promised that they're going to pay us 7%. And when it comes to the interest revenue is based on the amount that we paid for the bonds multiplied by the market rate, which in this case was 9%. That represents $14,400,000 for the entire year. We divide it by 2, which gives us 7.2 million, and that represents the interest revenue. All right, so that answers requirements 1 and requirements 2. So now for requirement 3, it's asking us to report and prepare any additional journal entry necessary for Tanner UNF to report its investment in the December 31st balance sheet. So we need to consider the amortized cost on the books. So based on this information, but again, because this is a trading security, if this was held to maturity, we don't need to account for anything, but it's not, right? We need to essentially account for the balance as of December 31st. So we first factor in, again, we purchased the bonds on July 1st. So the beginning balance was 0, right? We didn't have the bonds, but now we need to account for the change, the adjustment, the value of the bond. So it says that as a result of the change in market conditions, the fair value of the bonds at December 31st, 2024 was 170 million. All right. So that's something we know. It's 170 million. So I'll just do 170.0, right? It was worth 170 million. All right, so I'm just going to make this a little bigger. All right, so it's worth 170 million. So 170.0. This. All right, but then the next thing we need to factor in is, well, what is the current value of the bonds? And how would we determine it? We'll determine it as follows. So the face value is 200 million. All right, this helps to let me know how many zeros are missing. All right, so the face value of the bond is 200 million. From there, we would subtract the discount. So less discount, which is 40,000 or 40 million rather. 40 million, perfect. And how do we know that? The investment in bonds is 200 million. The discount is 40 million. And then the next step is we also need to factor in the amortization. And how do we determine the amortization? We see that there was a discount of bond investment. So discount less bond less discount amortization. I should put it on another line. So less discount amortization. Amortization. All right. So we also need to factor that in, right? How do we factor that in? So we see here that the cash, the interest we received was 7 million and the interest revenue was 7.2 million. So we need to factor in that $200,000. So we find the difference between these 40 million minus the 200,000, which gives us 39,800. Because again, at the end of the period, when these bonds mature, we want to be able, on the books rather, the investment in bonds needs to reflect the full face value. So therefore, 200 million minus the 39,800, the value of the bonds is currently $160,200,000. So with each interest payment that we make, there's an increase in value. So again, how do we determine the amount? We need to determine the amortized cost of the bond, and we calculated it as follows. The face value of the bonds, which is 200 million, we subtract or we factor in the discount, which was the 40 million. And then again, if we think about it from a T account, we have 40 million on the credit side, and then we have 200,000 on the discount on bond investment. If we net the two, and I'll do the math here. So we have 40 million, which represents the discount, the credit. And then we know that with accounting, one side increases, the other side decreases. So the discount on bond investment, the amortization of 200,000, this now brings the value in the discount on bonds account to 39,800,000. So now the amortized cost of the bond is 160,200,000. All right. So based on that information, so this would be 160.2. So based on that information, we need to determine what is the adjustment that must be made. So 170 million minus the 160.2. At the end of the period, we needed to show 9.8. All right. So think of it like a bank account. You start off with $0 in your bank account and you need $9.80 to pay a bill. That means that you need to deposit 9.8 into the bank account. So therefore, our journal entry is essentially going to be a debit to the fair value adjustment account of 9.8. So that way the ending balance in the account shows 9.8. So our journal entry would be as follows. We would debit our fair value adjustment account for 9.8. Again, as we see here to calculate the amount. And then from there, we would credit gain on investment. Gain on investment, unrealized net income for the 9.8. And again, the reason why we are treating it this way is because it is considered a trading security. So just to quickly recap, how did we determine the adjustment that is needed? It was based on the fair value, which it lets us know was 170 million. And then the amortized cost of our bonds is 160,200,000. How do we determine that? The face value and we get the net amount of the discount on bonds. Originally, we first set up the discount on bonds for 40 million, but we amortized the portion of it with our first interest payment received. So the balance in the discount on bonds investment reduced by 200,000. So the net amount was $39,800,000. So the amortized cost of the bond is 160,200,000. So we get the difference between the two. And because it is a trading security, we account for the changes in fair value through net income. Therefore, the ending balance needed to be 9.8. Hence, that is how we made our calculation. All right. And now for part 4, it says, all right, so suppose Moody's bond rating agency downgraded the risk rating of the bonds, motivating Tanner UNF to sell the investment on January 2nd, 2025 for $150 million. Prepare the journal entries required on the date of sale. So the first thing we need to do is, well, we need to account for the fair value adjustment. So as of 12/31/2024, we see that the ending balance was 9.8. We made that adjustment. All right. And then now we need to account for, all right. And now we essentially need to account for the change. So it was reflected as 170 million, the fair value, but now they're saying that they have to sell it for 150 million. So we need to determine the difference between the two. So how do we do that? $160.2, which represents our amortized costs. Bigger. 160.2, which represents our amortized cost, and it is currently being sold for 1.5. So therefore, how do we determine the amount? Again, this is negative. We have something that's worth 160.2, but we're selling it for 150. So this gives us a negative. Or let's actually do the reverse. We're selling it for 150 and it's worth 160.2. So therefore, it's a negative 10.2. All right, so the balance was a debit of 9.8, as we saw in our previous problem. And then now in this case, we know that the ending balance needs to be 10.2. It is negative, right? So we need to account for this negative adjustment. So in order for us to determine and get to this ending balance, our journal entry would be as follows. First, we need to account for the 9.8 plus the 10.2 that needs to be reported. So therefore, the change that is needed is going to be 20 million. So for our journal entry, we'll report it as follows. It will be loss on investment, unrealized, and again, it's unrealized. This is before we sold it. And then we would make the update to our fair value adjustment account for 20.0, 20.0. And then now when we actually have the sale, we debit cash because the problem lets us know that we received 1.5 million or 150 million rather. So we receive 150.0. We need to account for the fair value adjustment because we need to close this out, right? So we close out the fair value adjustment. And we know that the ending balance was 10.2, right? Because it was a credit balance and now we want to get it down to 0. So if we think of it logically, if we have a credit of 10.2 and a debit of 10.2, that nets out to 0. And then the next thing that we need to account for is the discount on bond investment. So the discount on bond investment, as we calculated previously, was 39,800. The original discount on bonds was 40 million, as we see here. And then we amortized 200,000. So the balance in our discount on bonds was 39,800,000. So we also need to zero that out because we sold it. We no longer have these bonds on our books. So 150 million plus the fair value adjustment plus the discount on bonds gives us a total of 200,000. What does that tie to? The total value of our investment in bonds. We no longer have it on the books. We sold it for $200 million. Or it's no longer on our books, rather, right? So we totally get rid of the value of the investment in bonds. So this would be the journal entry, again, to account for the change in fair value. And then this entry would be for the sale of the bonds for 150 million. All right, so I know there's a lot going on in this problem. Again, this is just an example of how we account for bonds that are characterized as trading securities. So we look at a similar problem. And now in this problem, we are looking at bonds that are considered available for sale. So it's not necessarily held to maturity and it's not necessarily a trading security. So here it says Tanner UNF Corporation acquired as an investment 300 million 7% bonds dated July 1st. On July 1st, 2024, company management has classified the bonds as available for sale investment. The market rate was 8% for bonds of similar risk and maturity. So one thing that we know for sure is that this was probably issued at a discount, right? How would we know that? We are promising to pay bondholders 7%, but the market is promising to pay them 8%. So therefore, we have to do something to appease the investors, because again, they can go and make 8% versus the 7% that we're promising to pay them. There's a lower demand to appease, and to entice them, we issue the bonds at a discount. So 300 million, 7% bonds. The market rate is paying 8%. Tanner paid 280 million for the bonds. The company is going to receive interest semi-annually on June 30th and December 31st. The market conditions are changing. The fair value of the bonds was 285 million. So the first thing we need to do is record the investment in bonds. So we have investment in bonds for the 300 million. All right. So it is reported on the books at the face value. The cash that we paid, which was 280 million. So obviously we see there's a difference between the two. And we know that because the market rate is higher than the stated rate, we have a discount on bond investment for 20 million, right? So now the next thing that we need to account for is the interest that we've earned. And how do we determine the interest? So we calculate our interest as follows. So the bonds are worth 300 million. We're actually going to put some dollar signs to these. Missing a zero. So we're 300 million. And we know that the interest rate that we promised to pay them is 7%. So for 0.07. So we're promising to pay them interest each year of 21 million. But again, this interest is payable semi-annually. It's paid twice a year. So 21 million divided by 2, we're promising to pay them $10,500,000 twice a year. And now we need to determine, all right, well, let's actually write the first part of the entry, cash, 10.5 million. And now we need to determine, well, how much is our interest revenue? So as mentioned in a previous problem, our interest revenue is based on the carrying value of the bonds. So 280 million. All right. And it's also based on the interest rate for the market interest rate. So the market promised to pay us 8%. So the carrying value of the bonds, which is 280 million, multiplied by the 8%, the market will promise to pay us 22,400,000 for the year. we divide it by 2. It'd be $11,200,000. So this represents our interest revenue. And then the next step will essentially be accounting for the difference. So the difference of 11.2, which is based on the carrying value of the bonds and the market rate, divided by 2 because we're receiving payments twice a year, minus the interest that the corporation promised to pay us, that gives us a difference of 0.7. So we would debit our discount on bond investment. So this will be our journal entry. We completed requirements 1 and 2. Now we need to factor in requirement 3. So requirement 3 states, prepare any additional journal entry necessary for Tanner UNF to report its investment in the December 31st, 2024 balance sheet. So again, here it's letting us know that as a result of the changing market conditions, the fair value of the bonds at December 31st was $285 million. So we know we purchased the bonds July 1st, so therefore the beginning balance is 0, but we need to determine what balance is needed as of December 31st. So similar to the previous problem, as of right now, the market is telling us is $285 million, but we need to determine what is the amortized cost of our bond at the moment. So how do we determine it? And I'll copy it from the previous problem. All right, so it's the face value, which is the 300 million. Now I'll just put a dollar signs to make sure we calculate it correctly. Perfect, 300 million. And then the original discount, which is 20 million. All right, which is 20 million. And then from there, we account for the discounts and amortization. So in this case, again, when we paid the interest, there was an amortization of the discount on bond investment of 700,000. Just remove a 0 of 700,000. So therefore, we need to determine the net in our discount on bond investment. So it's the 20 million minus the 700,000 that was amortized. So therefore, the amortized cost of the bond is the face value minus the current balance in the discount on bond investment. So therefore, the amortized cost of the bond is 280,700,000. So therefore, 280.7. In order for us to determine the amount that needs to be reported at the end of the year would be as follows. 285 million minus the amortized cost of the bond. We need to adjust for 4.3 million. So therefore, again, just like a bank account, you have $0 in your bank account and you need $4.30 to pay a bill. You need to go and deposit $4.30 into the bank account. So therefore, this was the beginning balance. We know the ending balance needs to be 4.3. So therefore, we deposit 4.3. Our journal entry would be as follows. We would essentially debit the fair value adjustment for the 4.3. And then we would credit our gain on investment, unrealized, All right. And keep in mind, one of the key differences is that in this example, right, we are looking at available for sale. And in the previous example, we were looking at trading securities, right? So there's a key thing for us to keep in mind as we are, dealing with these different kinds of bonds. When we are dealing with this kind of bond, we are going to account for it as unrealized OCI, other comprehensive income. So in the previous example, we essentially did unrealized net income because it was considered a trading security. But for our available for sale securities, we consider it a part of other comprehensive income. So please keep that in mind as you are preparing the journal entry. So now this brings us to the next part of the question. We just completed requirement 3. Now we have to move on to requirement 4. And it says, suppose Moody's bond rating downgraded the risk and they had to sell the investment on January 2nd for $260 million. It wants us to record the journal entry. So we know that the balance in this account was $4.3 million. All right, and now we need to factor in, well, what is the balance that is needed? So here we know we sold it for $260 million. So we need to determine. All right, we already know the amortized cost, which we calculated earlier. The amortized cost is $280,700,000, so 280.7. And we're selling it for 260. All right, so now we need to think logically. So we're obviously going to have a loss, right? How do we know that? Because again, we're selling something for 260 million and it's worth 280,700,000. So the ending balance is going to be a negative 20.7. So we have the 4.3. So now we need to determine, all right, well, what is our, what's the change that needs to be accounted for? So originally there was an increase 4.3, but then now we sold it for a loss. So therefore, the change that's needed is we need to credit our fair value adjustment for 25 million. All right, so we need to account for it. So then now it's asking us to account for or record rather any reclassification adjustment, right? So we know that first and foremost, we're going to need to get this amount balanced, down to 0, because here the balance as of January 2nd, 2025 is 20.7. If we need to get it down to 0, then obviously we're going to need to 20.7. We're going to need to reduce the amount to 20.7. All right, so just keep this in mind. I know there's a lot of moving pieces with this problem, but again, the first part of the journal entry, we're going to have 3 entries here. Again, we want to account for the loss on the investment. So loss on investment, unrealized OCI for 25.0. We credit our fair value adjustment for 25.0. And then from there, we account for the fair value adjustment. Again, we need to get this balance down to 0. It's showing 20.7. So therefore, we also need to reduce the balance in the fair value adjustment. Why? Because we sold it. So we need to get it down to 0. So we account for the 20.7. We take into account the reclassification adjustment to get that balance down to 0. And then now the last step is essentially accounted for the sale. So the problem lets us know that we received cash of 260 million. So 260.0. And again, we'll use what we know to figure out what we don't know. We know what the loss on the investment is. The loss on the investment which we know is the difference between the amortized cost of the bond minus how much we sold it for, which is the 20.7. Next, we account for the balance and the discount on bond investment, which we know is the 19,300,000. How did we get that? Originally, the discount was set up for 20 million. We amortized it when we received the interest payment for 700,000. So the ending balance in that discount on bond investment is 19,300,000. And then we add up the cash received, the loss on investment, and the discount on bond investment. And this is equivalent to the value of the investment in bonds, which is our credit. All right. So again, this brings us to requirement 4. There's a lot of moving pieces with this example, right? But again, it's ultimately dependent on whether it is held to maturity. If it's held to maturity, we do not account for any changes to the fair market value. If it is trading securities, then we account for the changes to fair value in net income. And if it is available for sale, we account for any adjustments to fair value through other comprehensive income. All right. So this brings us to our next question. All right. So for this question, this is asking about what journal entries we need to record. So here it states, LED Corporation owns 2.2 million of Branch Pharmaceutical bonds and classifies its investments as securities held to maturity. The price, sorry, I'm going to make this a little smaller. All right, perfect. So the market price of Branch's bonds fell by 1,034,000 due to concerns about one of the company's principal drugs. The concerns were justified when the FDA banned the drug. LED viewed $470,000 of the 1,034,000 loss as related to credit losses, and the other 564,000 as non-credit losses. LED thinks it is more likely than not that it will have to sell the investment before the face value recovers. In such case, LED is essentially going to need to reduce the carrying value of the investment, use an allowance for credit losses contra account, and they would record the loss. So in such case, the journal entry would be as follows. We would debit the credit loss expense. For the amount that they perceive is related to the credit loss, and in this case, which is 470,000. All right, and then from there, we would credit the allowance for credit losses for the same 470,000. Whoops, sorry, too many zeros. All right, for the 470,000. All right, so that'll be the first part of the entry. All right, and then the next thing that we essentially need to account for is done, well, how is the decline going to affect the net income? So in such case, it'll affect the net income, it's 470,000. And then from there, will not have an impact on the other, comprehensive income. It would impact the net income. So therefore, the net effect on comprehensive income is going to be the 470,000. Just keep in mind, this does need to be input as a negative. So it'll be negative, too many zeros, negative 470,000, negative 470,000. All right. So net income, and net effect on comprehensive income. So in the income statement, the 200, or in this case, the $470,000 loss is a reduction towards net income. Because this is a held to maturity investment, no non-credit losses are going to be recognized. So just keep that around. Let's keep that in mind rather. All right. So this problem was fairly simple for the most part. Again, this is a held to maturity investment. We recorded the journal entry, the amount that was recognized as a credit loss of $470,000. And again, because this is held to maturity, we do not account for the non-credit losses. So our journal entry was credit loss expense. And then we debited the allowance for credit losses. As far as the impact on the income statement, it would impact the net income. And then the net effect on comprehensive income would be the negative $470,000. All right, this brings us to our next entry. It states, on December 12, 2024, an equity investment costing $96,000 was sold for $132,000. The investment was carried in the balance sheet at $91,000 and was accounted for under the equity method. An error was made in which the total of the sale proceeds was credited to the investment account. So for this entry, it's asking us to prepare the journal entry to correct the error, assuming it is discovered before the books are adjusted or closed in 2024, and a journal entry to correct the error, assuming it was not discovered until early 2025. So how do we figure this out, right? We need to first think about, well, what would happen if, we didn't figure out the journal entry? So here's what we need to do. What was the journal entry that the company made? Or we could even, you know what, we'll just look at the map. We can actually set up a T account. This might help. All right. And the key thing here is that we see that there was a difference based on, how much it was reflected on the books. So here it's saying that the investment, cost $96,000, but the investment was carried on the balance sheet at $91,000, right? So that's essentially the error. So journal entry the company made. Make these a little bigger. So the journal entry the company made was as such. So we had cash of $132,000. All right, I'm just gonna make these a little more formatted. All right, so we recorded the cash of $132 million. And then we accounted for the investment in equity affiliate for $132,000, right? But the journal entry that they should have made company should have made as follows, right? So, I mean, we still received the cash of $132,000. Oh, too many zeros. $132,000, but we need to account for how much the investment was carried or reflected on the balance sheet. So the investment in equity affiliate, I'll just copy this over. The investment in the equity affiliate, in this case, it lets us know that on the books, it was reported as $91,000. So $91,000. And then from there, the difference would reflect the cash received, the value. So think about it like this. Something you own is worth $91,000 and you're selling it for $132,000. There is a $41,000 gain. So gain on investment. Right? gain on investments for the 41,000. So what we need to do to fix the entry, all right? So in order for us to determine how we need to fix the error, we know first and foremost that there's a difference. The investment in equity affiliate, it was reported at a credit of 132,000 when it really should have only been 91,000. So we know that we need to reduce the balance in the investment in equity. All right. So how much do we need to reduce it by? So investment in equity affiliate, the balance needs to be reduced as follows. The amount that was originally reported of 132,000, we need to decrease it to 91,000. So therefore, we need to debit the investment in equity affiliate account. And then from there, we would credit our gain on investment for the $41,000. All right. So that would be our first journal entry that we would need to record. All right, because again, we reported too much in this investment in equity affiliate account. So we need to reduce the balance by debiting and crediting our gain on investment account. So now the next part of the problem is asking, what about if we did not discover this error until 2025? So what that simply means is that, hey, well, the books were closed, right? And now we need to account for the issue. So in such case, we would debit. In such case, we would debit our investment in equity affiliate. All right, this account is on the balance sheet. It's not, a revenue or an expense account. So investment in equity. I'll just copy it over. All right, so this account is on the balance sheet. This is one of the permanent accounts. So this account, can be changed. But the gain on investment, our revenue, expenses, losses, and gains, all right, they do not necessarily want to be, or they cannot be just updated. Why? Because those accounts are closed at the end of each period. So therefore, we can still clearly account for this $41,000 in the balance sheet account, but this temporary gain account, unfortunately, we cannot account for it. So we use the permanent account that accounts for our revenue, expenses, gains, and losses, and that is our retained earnings account. So our retained earnings account would be impacted because the books were closed. All right, sorry, too many zeros here. All right, so again, key thing to keep in mind, we'll go over the problem quickly just so you understand the fact pattern. There was an investment that cost 96,000. It was sold for 132,000. And the investment was carried at the balance sheet for 91,000. They made an error. The total sale price was credited to the investment account. So this is the journal entry that the company made. They debited cash for 132,000. And they credited the investment in equity affiliate account for the total sale. But the journal entry that the company should have made is debit the cash for 132,000, write off the investment on the books, which was carried at 91 million. And then the difference between the two, we have something worth 91,000. We sold it for 132,000. That's 41,000. So therefore, in order to fix the error, we needed to reduce the balance in the investment in equity affiliate from 132,000 to 91,000. So the difference between the two is 132,000 minus 91,000. So therefore, the journal entry to fix the error would have been 41,000 debit to investment in equity affiliate. If we figured out this error before the books were closed, we would be able to credit our temporary gain account for 41,000, right? But because we know that our income statement accounts are temporary, they close at the end of each period. If we did not realize the error until after the books have been closed, instead of crediting the gain on investment account, we would credit our retained earnings account. All right. So this brings us to our last question. So here for this question, it asks, the following selected transactions relate to investment activities of ornamental insulation Corporation during 2024. The company buys equity securities as non-current investments. None of Ornamental's investments are large enough to exert significant influence on the investee. Ornamental's fiscal year ends on December 31st. No investments were held by Ornamental on December 31st, 2023. So we have to record all of these journal entries. So it lets us know that on March 31st, they acquired Distribution Transformers Corporation stock for $450,000. So our journal entry on March 31st would be as follows. We would debit investment in equity securities for $450,000, right? And this problem doesn't ask us to round, so we get to input the amount wholly. And then we paid cash of $450,000. So fairly simple. Next September 1st, it says we acquired $975,000 of American Instruments common stock. Similar entry, right? We debit investment in equity securities. And in this case, for $975,000. And then the next part of the entry is, well, we know that we paid cash, so therefore we credit $975,000 because we paid the cash. The next part of the entry, or the next entry rather, is it says that we received the $18,000 dividend on the distribution of Transformers common stock. So we received cash of $18,000. Why did we get this $18,000? Because of dividend revenue. $18,000. Now on October 2nd, it says we sold the distribution for Transformers common stock for $480,000. But hold on, before we get there, right? We need to account for the adjustment, the market price of the investments. They have fluctuated. How do we know that? So it basically lets us know that on October 2nd, the distribution for Transformer stock increased. How do we know? Because we sold it for $480,000. But hey, how much did we pay for it? We paid $50,000 for it. So we need to account for the adjustment. How much is the adjustment? $450,000 is how much we paid. It's worth $480,000. So therefore, our journal entry for the increase would be as follows: fair value adjustment of $30,000. And again, how did we calculate that amount? What, too many zeros? How do we calculate that amount? The investment in equity securities, $450,000 for distribution on Transformers Corporation, but then we sold it for $480,000. So we account for that $30,000 increase. So we debit fair value and adjustment, and we credit gain on investments unrealized NI. So now the next step is to actually record the sale. So it lets us know that we received $480,000. Then from there, we write the investment in equity securities off the books. So we debit investment in equity securities, or credit rather, the full amount for $450,000. And then from there, we need to get rid of the balance in the fair value adjustment. So again, remember, this is like an allowance account, right? It accounts for the fair value adjustments throughout the period, but when we actually sell it, we now need this balance to be reduced to zero. So we credit the fair value adjustment account for the $30,000. Keep in mind, we already recorded the gain on investment, and now since we're selling it, we basically just need to get this account balance down to zero. All right. So I know with this problem, there's a lot of moving pieces, but we are getting through it. So next, I want us to be able to see everything. So the next step is we essentially need to account for that. On November 1st, it says that we purchased $1,450,000 of M&D Corporation common stock. We've seen this journal entry before. We saw it on March 31st. We're now seeing it again on September 31st. we debit our investment in securities for the 1,450,000. And then we paid cash. So we debit cash for the $1,450,000 paid. All right. And now on December 31st, here it's asking us, it's saying that I'll hide this so we have more space. All right. So now December 31st is saying to record any necessary adjusting entries relating to the investments. And then it basically lets us know the market price of these assets. So we no longer have this investment. We know that we sold it already. So we need to account for the American Instruments stock as well as our M&D Corporation stock. So here's how we can figure it out. I'll actually make another column here. So this represents the fair value. And then we account for the cost. So we'll have a quick, side by side so we can get a better understanding of what exactly is going on. So the fair value for American Instruments common stock is $920,000. For our American Instruments common stock, we paid $975,000 for it. All right, so we see that there's a difference. We paid $975,000 and now the fair value is $920,000. And then we see for our M&D Corporation stock, we paid $1,450,000. And there was an increase to $1,515,000. So we need to factor in the gain on sale of investments. All right, so how do we determine this? The cost minus the fair value. The fair value rather minus cost, right? So there's a $55,000 loss for the American Instruments common stock. And for our M&D Corporation stock, the fair value minus the cost, which lets us know that there is an increase of value. So therefore, we now net the loss from American Instruments common stock with the increase for the M&D common stock. So therefore, there is a $10,000 overall gain that we need to account for. So we need to record the fair value adjustment to account for this increase. So therefore, our journal entry on December 31st, again, is similar to this entry that we saw before. We debit our fair value adjustment for the net increase of $10,000. And then we credit our gain on investments, unrealized NI, net income for the $10,000. All right. So that is us essentially accounting for the difference between the cost of the stock, how much we paid for it, and the market value at the end of the year. All right. So now the next part of the problem asks us to indicate any amounts that would be reported on the financial statements, right? So we have the income statement, we have the statement of other comprehensive income, and then we also have the balance sheet. So it's asking us to report, what would be reflected in these amounts. So how do we determine these amounts? So we look to see all right, the amounts. And here we see that we need to, again, factor in, hey, what is the balance going to be in these accounts? So the dividend revenue, how do we determine the dividend revenue? Okay, we clearly look on the journal entries that we've recorded. Dividend revenue is $18,000. How do we determine our gain on investments? So in order to determine our gain on investments, we need to factor in how many times we have, hit the gain on investment account. So the gain on investment would be calculated as follows. The gain on investment that's reported on this entry on October 2nd, plus the gain on investment that was reported on December 31st for $40,000. So Based on that information, we see that the total net income impact is as follows: $18,000 of dividend revenue and $58,000 for the gain on investments. Next, we factor in our statement of comprehensive income. So with our statement of comprehensive income, we start off with our net income of $58,000. There's nothing impacting our other comprehensive income. So our other comprehensive income is equivalent to our net income. And now we move on to our balance sheet. So for our assets, we have our non-current assets. We want to determine the value of our investment in equity securities. So in order for us to determine our investment in equity securities, we will account for every increase that has taken place, right? So we consider we sold that, or we can do it. All right, 450,000 plus 975,000. From there, we subtract the 450,000 and we add the 1,450,000. So that gives us investment in equity securities of 2,425,000. Now, the next step is we need to factor in the fair value adjustment, right? So we account for how many times we hit the fair value adjustment. So we had a positive fair value adjustment. We had a decrease to our fair value adjustment. And then we had an increase for the $10,000 to our fair value adjustment. So the ending balance in our fair value adjustment is $10,000. So when we net the two, 2,425,000 less, or plus rather, our fair value adjustment, which is the positive 10,000 left over, then our next step that we need to account for is, well, what is our retained earnings? Our retained earnings stems from our comprehensive income. All right. So I know there was a lot going on in this problem, but again, the key thing is that we're gathering all of the information from the journal entries that were prepared. So I hope this video helps, and I know that there's a lot going on in this question. There's a lot to consider when we are accounting for debt and equity investments for corporations when they invest in another corporation. But again, just some key things that I want us to go over as it relates to equity securities. Do they have significant influence over the operating and financial policies? If so, the reporting method is fair value through net income. If the investor has significant influence, we use the equity method, and this is typically between 20 to 50% ownership of the voting stock. But the key thing is, do they have influence over the operating and financial policies? And lastly, does the investor control the investee? If so, we use the consolidation option. As it relates to our debt investments, the key thing is we need to determine how is it classified, right? Is it held to maturity? If so, any unrealized holdings, gains, or losses are not recognized and it's carried in the balance sheet at the amortized cost. Is it a trading security? If so, it is recognized in net income and carried in the balance sheet at fair value. That is why we need to keep, doing the journal entries to account for the increases or decreases. Or lastly, is it available for sale? If so, it is recognized in other comprehensive income and carried in the balance sheet at fair value.